Explosive. That's how we would describe the stock market today. The stock market absolutely exploding higher. We got a lot to go through in this video here today. There's going to be 3 videos I want to react to. First, we're going to talk stocks. At the beginning of this video, I want to talk about some of the moves out there, what I'm seeing out there. But I do want to react to 3 video clips in this one. First thing is Tom Lee went on CNBC about an hour ago, talked about what he's expecting for the markets moving forward. So I want to react to that one. The Professor, Jeremy Siegel. Looking forward to reacting to this one from 4 hours ago. This was the best news I've heard from the Fed in years, he says. And Steve Eisman, he's Mr. Big Short. He went on Bloomberg 51 minutes ago, spoke about a range of subjects. So looking forward to getting into that one. Appreciate y'all joining me. As always, thank you so much for being here. Hope you're making some dang money out there. Hope you're getting your flapjacks flipped all over the place because there's definitely a lot of money to be made out there. Appreciate y'all. Thank you for smashing that thumbs up button. Thank you for being subscribed here to the channel, folks. We are now 50,000 plus subscribers. It's a big number. I appreciate y'all for being here, okay? So let's talk about some moves before we react to these videos. First off, Tesla, great day, 7% mover here today, phenomenal. We're going to just talk about stocks I'm invested in here at first, and then we'll go a little bigger picture after this. PayPal's having a great day. PayPal crossing 77, which is by far and away the highest that stock has been all year. So very happy about PayPal. There's also a lot of developments in regards to PayPal. I might do you guys a video tonight on this channel regarding PayPal. There's a bunch of different moving parts in regards to PayPal. Actually, there's a bunch of moving parts in regards to Palantir I got to speak about too. So I might do a full-scale Palantir and PayPal video later tonight. So just keep that in mind. We'll see. Shopify's having a great day, up 4% plus. SoFi's having a good day. Could SoFi get to new highs of the year? So when we first entered the year, SoFi was, a little under 10. So, but it was only there for like a second and then it was straight down. So, I mean, we get a few more updates for SoFi and we could be looking at new 2024 highs for SoFi. Meta's new all-time highs. I believe this is a new all-time high for Meta in its history. Yes, indeed it is. 556. Absolutely phenomenal to see. Meta is my biggest position in the public count, followed by Tesla's number 2 and PayPal's number 3. So when these stocks are rolling, it's a lot of fun. Wynn having a good day, 2% there. The Planet having a decent day, up 2%. Zoom's up about 2% today. Nike's up, Amazon's up, Elf on the Shelf is up, Revolve's up, Cake's up, Palantir up again. I mean, my gosh, Palantir is just an animal that stock is. Let's go ahead and take a peek at big tech. So out of big tech, AMD's up pretty nicely here today, up about 7%. NVIDIA having a nice bounce back day, 5%, which doesn't come as a surprise. When the Nasdaq's up this much, when you have stocks like AMD and Tesla moving this big, NVIDIA is going to roll. And sure enough, like NVIDIA is rolling today. Only stock red. Out of all the stocks on big tech is IBM here today. But look at that. I mean, if you're only up 2% today, that's seen as a disappointment. Google's only up about 2%. Google stock's been incredibly weak. It's kind of, Google stock's actually somewhat interesting to me, guys. It is. Man, that stock is just incredibly weak. I mean, given the year that we have, you could compare Google McDougal. Let's compare it to its peers here, which would be Meta, right? And I think Apple. Apple and Meta are always the most direct peers to Google. And if we see here, I mean, it's getting beat out by Apple on a risk on year. You would think Google should be beating Apple, yet Apple's winning with its extremely slow growth rates for Apple. 23% Apple's up, 17% for Google McDougal, and then Meta's just destroying them, up 60% this year. So definitely goes to show you how much weakness there is in Google. But with that being said, the stock is somewhat interesting. Let me pull a valuation on Google McDougal here. So in regards to valuation with Google, stock looks pretty attractive actually. Forward P of 22 on this one, 2-year out forward P of about 17. Next year earnings per share growth should be strong for the company. Next year revenue growth should be strong for the company, double digits. So that's looking really dang good. If we go to the compare feature here on 1000xstocks.com, let's go ahead and compare Google versus those 2 peers when it comes to valuation. We compare them next to Apple, and we're going to compare them next to Meta. They're 2 most direct peers out there. Let's go ahead and compare. Look at that. In a matter of a second, it did it, right? So Meta trading richer than Google, but the company has been more well run, we got to be honest, and had better growth rates than Google has. So you should kind of command a higher forward PE, 2-year forward PE than Google McDougal. When it comes to Apple, Apple's trading far richer than Google, which, honestly, I don't know if that should really be that way, because we got to understand Google does own Android. Android is the big dog in the smartphone space, right? And we do have to understand, like, Google has obviously Google search, which is massive. We all know that, right? Could be getting disrupted. That is the risk with Google in regards to ChatGPT. They own YouTube. They own Waymo. They own so many different businesses. It's incredible. YouTube TV, obviously, which is a giant. So, I don't know, man. Google's actually kind of interesting here. It really is. If there is something that kind of tempts me out of big tech, it might be Google McDougal. The question is, if I had no money invested in Meta, would I buy Meta or Google? Ooh, I might still go Meta, to be honest, if I had no money invested in Meta, right? Commodities. So when it comes to commodities, GSG popping today about 2%. But this baby is still down very nice over the past year. GSG is down 8%, which bodes very well for inflation over this next year. So when do I get worried about commodities? Like in terms of like, oh, this could actually start hurting us in inflation numbers. If we see GSG go to kind of the 24 to 25 range, I begin to get concerned, okay? That's what we need to see. Oil, when do I get concerned about oil? If we see WTI go to 90 plus, that would concern me in regards to oil price, gasoline prices, those sorts of things. So 90 plus, I start to get freaked out a bit. GSG goes to 24, 25, I start to get freaked out a bit, and then I actually start worrying about inflation again. We're obviously a long way from there right now, which is great, but, something to kind of keep in mind here. As far as potential hedges, Coinbase is a potential hedge for me next year. Nail's a potential hedge for me next year. Caterpillar, Toll Brothers a potential hedge for me next year. Chipotle, Costco, Wingstop, those are all potential hedges for me. We'll see what I end up doing. I'm going to likely make moves in October in regards to my hedges. I just got to figure out where I want to go there. I'm not sure where I want to go. Like part of me wants to buy puts on Nail, but the premiums you have to pay are ridiculous. I don't know about that. Part of me wants to buy puts on Toly Moly. I don't know. We'll see about that. Part of me even wants to buy puts on Costco. Costco's valuation's absurd. You guys seen, just some of these valuations of some of these stocks is just absurd. No. Actually, I want to keep Google McDougal up there. I want to keep Google McDougal, but let's go ahead and play a game. Let's put Costco in between Google and Meta. Now, is Costco a better business model than Meta or Google? Absolutely not. Of course not. It's not even close, right? The margin profiles aren't even remotely close. Google and Meta can do business all over the world. They make money the easiest way possible, which is basically just selling ads. Like those businesses are the creme de la creme. And you look at Costco's valuation next to Google and Meta. That's silly. Costco's either Meta and Google are massively undervalued or Costco's massively overvalued. It's one of the two, right? This is just ridiculous. The valuation on Costco is crazy. So Costco's got a big fall ahead. It'll fall when the S&P falls, so that's the thing with that one. When Wingstop, you want to go even crazier, look at Wingstop's valuation on this one for a very subpar wing place. 122 forward PE. 2-year forward PE, they need a 4x to 5x their revenue and earnings per share to even start to justify this valuation. That's ridiculous. Ridiculous in regards to Wingstop. Makes no dang sense. Chipotle's trading rich, but I already made good money recently in regards to those Chipotle puts. I don't know if I'm interested in going back and attacking that one again. I don't know if I want to double dip it, to be honest. So Chipotle, I might let that one go. Toll's an interesting one because that valuation looks really cheap, but it doesn't mean the stock couldn't crash 40, 50% still. And the reason being, with a stock like Toll, if all of a sudden their orders start to dry up next year because there's a flood of inventory comes in the market, that could hurt Toll, right? So it's just kind of something to keep in mind there. So we'll see what I do with potential hedges. And then my potential buys watch list here today, it's a lot of green. I don't like that, right? That's a downside of when you get the market to go really green like this. Yeah, you make a bunch of money on your current positions, but your potential buys, right, or the stocks you are buying, I'll be buying stocks tomorrow. I mean, they're just at a lot higher prices. And that's the sad part of it all, right? That's the sad part. So it's a lot of green, a lot of green. Alrighty, guys, let's go ahead and jump into these videos and do some reaction. But yeah, definitely some great moves out there in the market. Cheers to everybody making money.
5,200, Tom. I know you agree the cycle has started and there is a Fed put in place, but it doesn't sound like you're willing at this moment to add a lot more risk.
Good morning, Carl, and thanks for having me. You know, Carl, I've got, I think, two time frames. I think what Steve said about the recalibration is really important because I think investors also need to recalibrate. There are too many that were in the camp of a hard landing coming, or the Fed would be too late. And this Fed cut cycle, I think, is setting the stage for markets to be really strong over the next 1 month or next 3 months. But what the stocks do between now and, let's say, the election day, I think is still a lot of uncertainty. And that's the reason why I'm a little hesitant for investors to dive in. But if I was going to advise where to be positioned, Carl, it's exactly what you said. It's cyclicals, which is industrials, financials, and small caps.
Right, with a preference for that.
Darden Restaurants, their numbers came out. They own a bunch of different restaurant brands. They're kind of a restaurant giant. But their big dog brand is Olive Garden. Sales were very disappointing at Olive Garden. If I recall, it was down close to 3%, their same-store sales at Olive Garden, which just goes to show me even more so that Cake's North Italia brand is really positioned for this next 10 to 20 years in terms of expansion, in terms of really getting that consumer taste. Because Olive Garden always kind of been very, in terms of Italian food quality, Olive Garden's always been very kind of lower tier, right? And I think people are ready for like a higher tier, kind of more national brand. I think that's where North Italia is going to emerge over this next 10, 20 years. And Olive Garden is kind of facing kind of a Chili's, Applebee's type fate, I feel like, over the next many years.
Over your traditional Mag 7 tech AI build-out trade?
I think tech and Mag 7 still keeps up with the market, and that's why someone owns it and they have tax implications. I wouldn't sell it. But for all these folks that have been sitting on defensive positions or thinking the Fed cut was going to be too late and the market was going to, equity markets were going to fall, I think those folks have to allocate into cyclical stocks, especially small caps, because they are not only sensitive to the cut in rates because of variable rate debt, but they're going to benefit from the cyclical boost to the economy as mortgages, the cost of mortgages drop, auto loans, credit cards, the lift to the consumer, potential M&A. All these are big tailwinds for small caps.
I guess then the risk to this, Tom, is that inflation comes back, right? If you're talking about this big cyclical recovery because of what the Fed's doing.
Yeah, but to be fair, though, you're always going to have inflation in the economy. Like, we have to get out of this mindset of like thinking like 2 to 3% inflation is going to ruin everything and we're done and the Fed's going to have to raise rates. No, the Fed's actually fine with 2 to 3% inflation, just to be quite honest. Where we have issues is whenever that CPI goes above 4. That's when we have problems. That's when the Fed starts kind of getting really freaked out. They start having to raise rates, consider raising rates, so right. If we're around 2.5%, 3.1%, 3.5%, the Fed's going to be in no panic mode in regards to that. And that's not a panic mode for you as an investor. But if all of a sudden you see a CPI approach 4, go over 4, now we're talking. You see a 5, okay. Now you need to start getting very scared. But that's just something to keep in mind. We should always have inflation. Always. If we ever don't have inflation, that means, it got really ugly out there. That means we're facing deflation, right? Which means ultimately we're likely in a massive, massive recession.
It's true. But I think one thing investors have to distinguish is that real growth, like GDP growth, doesn't mean inflation pressures, because inflation is, a mismatch of supply and demand. And I think there is a lot of excess supply potentially coming. For instance, housing could have a supply response. And if you look at the two biggest drivers for inflation for the past 8 quarters, it's been shelter and rent rolls and auto insurance. And auto insurance I think these insurers have reached sufficiency, so you're not seeing the premium increases anymore. So unless the rest of the CPI basket accelerates, inflation is actually falling pretty sharply.
Yes.
Hey, Tom, on the labor market, we're going to get 2 prints before the November meeting. Some of these doves are arguing that labor is going to force a faster pace of cuts because historically they argue the change in monetary policy doesn't get felt in the labor market for 4 quarters, and the peak impact is not for 8 quarters. I wonder if you agree.
I mean, I don't think there's anything wrong with people looking at the history of labor markets, especially as people know, as labor markets slow, it has a cycle of its own. The one thing that I think we have to keep in the back of our minds is that CEOs have been cautious for the last 2.5 years because the Fed telegraphed a tightening cycle to fight inflation. So I think that the fact that rates and now we're in an easing cycle means that companies are going to actually start doing expansion. So I think the labor market and the Fed is mentally knocking down these monthly numbers. I think tailwinds are emerging for labor markets to actually strengthen.
Yeah. Well, claims would definitely back you up today at 219, even though some argue about seasonal distortions. Tom, look forward to talking in person soon. Tom Lee this morning.
All right, Tom Lee. So Tom Lee, listen, that's an interesting Tom Lee. He still, I got to say, for Tom Lee, almost bearish, right? You got to understand, Tom Lee definitely fits into the camp of people that have come across as perma-bulls, right? And so hearing Tom Lee's commentary there, he's still kind of uncertain, still talking about, well, if I had to tell somebody where to put money in the market, those sorts of things. I thought he brings up a great point in regards to a lot of people off sides, convinced a hard landing. You don't have it yet. The Fed's already lowering rates. What do you do? And that puts a pressure on folks that are maybe off sides in this market and aren't really invested very heavily. And he does bring up a good point in terms of if those individuals are going to try to play catch up to this market, you're going to have to play it through small caps now at this point in time, right? The Professor Jeremy Siegel.
University of Pennsylvania's Wharton School of Business. He's also chief economist at Wisdom Tree. And Professor Siegel, this is what you thought the Fed should do, not necessarily what you thought they would do. What's your reaction this morning?
His camera's high quality.
This was the best news I've heard from the Fed in years. And by the way, let me guarantee you an all-time high for the stock market today. There's not going to be a back and forth the way there is yesterday. And the word recalibration is extremely significant. I think what they did is they said, listen, we're 100% towards our target on employment. We've got that back to normal. We're 80 to 100%, depending on what data you use on inflation. And we haven't moved at all until yesterday on the Fed funds. We say, the neutral Fed funds is 2.9%. And, why aren't we closer? We're now thinking about that gap, which is exactly what I talked about a month ago. Not these baby steps. Think about the gap. And now what it is remarkable. In the June meeting, they thought there was going to be 1 cut by year end. Now the September meeting, and by the way, the data hasn't been all that much different. Now 4 cuts. 2 that we had yesterday, 1 at each of the other meetings. And by the way, I've been looking at the market, figuring in what I see, and they expect 1 cut at every meeting over the next, 6 meetings that we're going to have through June of next year. That will bring the Fed funds rate down 200 basis points to 3.33%, which is where I think it should be. So, this is fantastic news for the market and great news for the economy.
Jeremy, I can't help but think of what our first guest this morning, Roger Ferguson, had to say. He's the former vice chair at the Fed. He wanted 25 basis points, but he said you could make the case for either 25 or 50. His point, as somebody who's been in that room for a long time, is, maybe the market's getting ahead of itself. It got this 50 basis points, and now it thinks that that's the norm, and that these cuts are going to come fast and continuously, and that may not be the case. You said that the market welcomed a big cut and it wants more. What if the market is just getting ahead of itself and those big cuts aren't to come, that this was, okay, we're going to front end load it, and then we're going to go slowly? Would that be a huge disappointment?
No, because as I mentioned, if I'm looking at the futures market, and by the way, I think right now the Fed dot plot is in almost complete sync once you make that risk premium correction with 25 basis points, not 50. I mean, clearly, if the data gets really bad over the next few months, we will get some 50s. But right now, they will be happy 25 at the November, 25 at December, and then in each of the first 4 meetings of next year, you do another 25 at each of those. That's all you need to get 200 basis points. That brings you down to 3.3%, which is pretty much where I think, the Fed says 2.9 is their long run. I think it's a little higher. I think it's closer to about, probably 3.5. So, they don't need 50. They say 20 at this point with
what
these
if inflation
new commitments.
Picks up? Because we're not at 2%. If inflation shows any signs of picking up and the Fed says, hold off, we're not going to do anything else anymore.
That's correct. But I don't see any sign of inflation picking up. I mean, I took a look at the markets, the oil markets, all those markets going ahead. This Jeff Gundlach was on right afterwards. He said his model actually shows a year-over-year.
Yeah. Jeffrey Gundlach, every single time after the Fed, they put him on. Like I didn't even know he was going to be on. And yesterday after I got done, I'm like, watch, Jeffrey Gundlach's going to be on. And sure enough, they put him on.
Next year, when those shelter numbers come in, it's going to fall below 2%. Now, I don't know if that's going to be the case, but that certainly is not a situation where we're off to the races again. The commodity markets, those sensitive markets, they tell you when you're off to the races. They told me in 2020, 2021, it's a totally different picture today.
Okay, Mr. Professor, Dr. Emeritus Wharton, Penn Wharton.
Yes.
You got one side saying, hey, Wharton loves my plan. And then you got the other side saying, hey, I went to Wharton. All right, so Wharton likes my plan. So pick your poison. Pick your poison. Let's see, you got across-the-board tariffs and no taxes on, well, both of them say that. And then on the other side, you got price controls, taxing unrealized gains, raising the corporate tax rate, and raising the capital gains rate. Pick your poison. Which of these blockbuster economic plans of the two candidates does Wharton actually stand behind?
I don't think any. I think all of them are, extreme, and none of them are going to be implemented.
100%.
It's going to be a close election. I think it's going to be a divided government. So,
and Wall Street knows that none of that crap's getting through. That's why the market's rallying the way it is. If anybody actually believed any of this crap's going to go through, believe me, the market would not be in the position it's in right now.
It's going to be, and that's exactly what the market wants.
Great.
Harris might be ahead a bit now. I actually think, if I had to come down on, I think she'd win. But I think the Senate's going Republican. The House is going to be very close. You can't get your wish. Either Trump nor Harris could get their wish list done, and so it's going to be blocked. Thank goodness the market said that.
Yeah, and that's funny. Thank goodness neither of the plans has any chance of seeing the light of day. That's the cynical.
Except for the renegotiate at the end of next year, as we all know, that is the big time renegotiation. There must be a renegotiation of a lot of taxes by the end of next year. If it's a divided government, it'll be a lot of compromises going on.
Should they stay in or come out? Should they be rescinded? Should we get rid of them or keep them?
Well, I'm pretty shocked. The SALT deduction, the Democrats were screaming when Trump put it in, and then Biden kept it when he controlled both houses of Congress. And now the Republicans who signed it are saying they don't want it. Right. So you go figure it out, Joe.
Oh, gosh. Next one up here, Steve Eisman, the big for short.
Basis point cut. It doesn't really rock your world.
Let me tell you about my day from a PM's perspective about what actually happened. So, prior to Fed Day, I get 3,000 emails about what the Fed's going to do. And then the Fed does what it does, and I get emails of redlined. It's like every word that is changed is crossed out. Every new word is put in. It's like they treat this like Moses coming down with the tablets. Or the Ten Commandments are still in the same order that they were in, and. But it's an important communication function because the Fed knows they treat it like the Ten Commandments, so they take it seriously as well. But 25 basis points, 50 basis points. And every time the Fed does whatever it does, the market has absolutely no idea what to do the very first day. And then think about today. So the market's up a lot and rates are higher. Like, that shouldn't be. If everybody's so into like what's the Fed going to do, a rate's going to go lower, so the stock market went up. Well, rates are up and the stock market's up. So I think it's worth a lot more. It's much more important about how's the economy doing, and if the economy is fine, you could buy stocks, and if the economy is going to go into recession, you can't. The rest is gobbledygook.
What do you think is going to happen, though, at this point, though? Because you think about what the bond market is doing, and it's showing you a different story. The exuberance in the stock market is not being reflected in a bond market that seems to be more worried.
That's the point.
Who's right? Yeah, but
I know the bond market is worried. The economy is okay. So why should long-term rates go down that much?
Well, tell me this. You were looking at a market not only rallying to intraday records today, you're looking at a Philadelphia Semiconductor Index up almost 3.6% today. How are rates going to impact the AI story?
They don't.
So
they don't really impact it at all.
What is the sense
of this trade?
Like I
said, people spend a lot of money and a lot of time trying to figure out what Powell's going to do, and that was intentional, by the way. And I don't think look, if the Fed's raising rates very, very aggressively, that's important. And the Fed's cutting rates extremely aggressively, that's important. Everything in the middle, it's just not that important. It's better to focus on the economy.
So what is your take on the economy? I mean, we saw a retail sales number the other day that I think was surprising. If you don't see that the U.S. consumer sort of beats expectations every single time, right? So the economy's growing at like a 3% clip. Unemployment's at 4.2%, right? Inflation's back down to like 2.5%. Is everything good?
Well, not everything is good.
No, but I mean,
there has definitely been a slowing in the economy.
Was it a soft landing? Was it a soft landing?
Well, there's been a slowing in the economy. The lower-end consumer is somewhat stressed. They're spending less. But, there's been an increase in delinquencies, but not terrible. So on the margin, things are a little bit slower, but inflation is cooler. So as far as I'm concerned, things are fine. Now, there are people out there who are still saying there's a recession going to happen, right around the corner. And maybe they're right. But as far as, the current data is concerned, I don't see that.
This is like what Ron Temple was telling us yesterday from Lazard, that the economy has gone from really strong to just strong.
So if you have a strong economy, if you are not that worried about a recession, it seems, you have a S&P 500 at above 5,700 right now. Where does it end next year? I mean, at this point, how much more growth is there to be had in equity prices?
Yeah, I guess that's a question about valuation. I don't generally get all that exercise about where the market valuation is. One thing I learned in the dot-com bust was, leading up to the dot-com bust, a lot of commentary about how things are ridiculously expensive, and all that commentary went right out the window because nobody cared. When did they care? They cared when the economy really rolled over and the fundamentals of those companies rolled over. Then everybody said, my God, these things are ridiculously expensive.
That's true.
So, and as long as the economy...
He's just spitting facts there, 100%, right? It comes down to the fundamentals of these companies. It comes down to the economy, right? If things go south in regards to company earnings, well, then all of a sudden everybody starts to care about valuation. But when companies are reporting great earnings, and when you got unemployment rate in the 4s, it's just people aren't going to take very serious the talk about valuation in regards to the market. It's once those things change, then all of a sudden people start paying attention. So he's right on. He's spot on.
Fine. I think the general direction of the stock market is up. How much? I have no idea.
But as long as the economy is fine, because we were talking about yesterday, again, the parallels between maybe NVIDIA and a Cisco in 1999, right? As long as the economy is fine, that doesn't...
Cisco broke when the economy broke.
Right.
And so therefore its fundamentals rolled over. if the economy really broke, I'm sure NVIDIA's fundamentals would probably break too, and we'd be having a different discussion. But as long as the economy is okay, it's a different story.
So tell us about your portfolio then. You're not shorting anything, right? You're long like 30 to 35 stocks. You got your own little Dow Jones going there. How's that portfolio look? How do you construct it?
So Eisman Group, there are three of us. It's me, my sister, and my brother-in-law. All in the family.
Nepotism.
All in the family. And we get along pretty well, thank you.
It's the name.
And we've become fairly thematic. I mean, we certainly have individual securities that we love, but the two dominant themes in the portfolio would be AI/tech and everything kind of related to it, and infrastructure. We think those are the best stories, and one of the things that I've said in the past is that in good times, people care about stories, and in bad times, they care about balance sheets, and we're in story time.
But in the sake of that AI conversation here, too, I understand what you're saying about Cisco breaking with the economy and worries about that when it comes to NVIDIA in the future. Extreme situations. But what about valuations in the AI world? How long will it take to see more payout in the investments being made?
I actually think it's going to be longer than people think, which is actually good for NVIDIA because it means they got to sell a lot more chips. And one of the reasons why I think that is Accenture, the business that is doing poorly is their consulting business. But the business that's doing well is their outsourcing business. And the reason why the outsourcing business is doing well is that most companies, and we're not talking about the big, AI plays, but everybody else has hired Accenture basically to clean up their data. That their data that they have is in different places, it's not clean, and so whatever they want to do with AI, they're not even in a position to do it until the data is structured in a way that they can then do it. We're still in that stage. So until we get past that, and then companies are going to start trying to figure out what they can actually do with AI, it's early.
It's interesting. You came out of 2008, you came out of 2020, you came out of these big market moments, and you kind of redefined the narrative, right, in terms of what you thought would be the kind of cyclical trends over the next 5-10 years or so. Now that we're in the beginning of this historic rate cutting cycle, is this the AI economy? I mean, you're seeing so many dollars. You see it in the trade today even. This is where the money is going. What does that mean in terms of how investors have to recalibrate the way that they put money?
I don't have to recalibrate. Like I said, good times is story time.
Yeah.
And, where are there good stories? There are those big two. There's some others, and an area where I think, for example, there isn't a great story is just in traditional banks. Nothing against traditional banks. They're all well capitalized. They're fine. They're safe. But can you construct a story that tells you that you really want to own banks? The only story that you can construct would be that Trump wins and the regulatory environment changes. And that would be good for a pop, but that's not a story.
True. Yes, I agree 100%. The only bank that really has a story around it is this one right here, this $8 stock named SoFi. That's really the only one, okay? Appreciate you guys joining me as always. If you're looking to apply, join my private stock group, private wealth group, get access to 1000xstocks.com, access to my private Discord chat, see the moves I'm making my $2.4 million plus Fidelity account and all those sorts of things. Then you can click the pin comment down there, fill out an application. We'll see if we can get you access next week. Much love and have a great day.